Now we'll pick up these values from the present value table. So you have the present value table over here. Okay. Here we have the future value. We're going to look for the present value computations. And here we have the present value interest factors for $1 discounted at X per K% for N periods, so and so. Okay. 6% over here we have it. For the first year, no. Are we going to look at that? Oh, one second, guys. I just sure need to rectify something. Okay, this is what I was thinking. It's wrong. Initial investment is going to be coming over here, and this is going to be $77,000. And this remains the same from year 1 to year 4 because this inflow is going to arrive to us at the end of the year 1, and obviously $1 at Jan 1st will not have the same purchasing power as on December 31st. So here we're going to go with the same previous assumption that the inflow starts from year 1. So that will help us to reconcile this with the present value table over here, or else it might be just confusing that why did we start from year 2 and not from year 1. Okay. So 6% present value factor for the initial investment, it's going to be entirely the same. $1 is the value is $1 on the same day itself. But $1 at 6% at the end of year 1, it's 0.9434. 0.9434. I think I need to increase the zeros decimal, right? For the next year, it's going to be 8,900. So it's 0.8900. Okay. That's four decimals over here. For the third year, it's going to be 0.8396. 0.8396. For the fourth year, it's going to be 0.7921. 0.7921. For the fifth year, it's going to be 0.7473. 0.7473. For the sixth year, the value of $1 is going to be 0.7050. 0.7050. Seventh year, it's going to be 6.651. 0.6651. 0.6274 for the last year. 0.6274 for the last year. Perfect. Now it's simple. We're just going to multiply the net cash flow with the present value factor, and that goes for the same. The same formula applies for everyone. And you have the dollar values over here. Right. So let's round this off to 0 over here. Okay. Perfect. Now, if we put this in accounting format, we'll have the currency figure here. Right. So now the net present value is your sum of the total outflow minus total inflows present value minus the cash outflow. If you remember from the definition, net present value is the present value of the projected future cash inflow. This is the amount of the projected future cash inflow, that is 5,10,631 against an investment of 5,01,000. So here you have a net present value, a positive net present value of $9,661. Therefore, the project should be accepted. I just mentioned note here, since the net present value is greater than zero, the project is profitable, hence should be accepted. So this is how you interpret the entire cash net present value of the project. So here, now let us try to figure out what would have happened if you had taken the discounted at 8%, just so to get one more tweak in the whole scenario. We'll use the same formulas over here. The only difference is going to be in terms of we'll write here, assume that the discount rate is, we'll just double it up, 12%. So we have this over here at 12%, discounted cash flow at 12%. That's all. These numbers are going to change, the rest all things remain the same. So if you see this thing over here, we have the 12% discount rate over here, and the initial investment is always going to be remain the one, because you're going to invest the amount today itself. If it's going to be invested in the future, then obviously those amounts need to be brought to the present value, but we'll avoid that high-end competition as of now. We'll just stick to the basics right now. Let's change the present value factors over here to 12% from 6%. So for the first year, it's going to be 0.8929. 0.8929. For the next year, it's going to be 0.7972. 0.7972. Notice this thing, because it's a formula based thing, then the moment you enter the present value, revised present value over here, all the computation take care of itself. For the third year, it's going to be 0.7118. 0.7118. For the fourth year, it's going to be 0.6355. 0.6355. Fifth year, it's going to be 5674. Sixth year, it's going to be 5066. 0.5066. Seventh, it's going to be 4523. 0.4523. Lastly, eighth year, it's going to be 0.4039. 4039. Oh, the results change drastically. Now, if the company accepts this project, it will end up in the negative net present value of $96,268. That means against an investment of $501,000, the company is going to have a loss of $96,268. So over here, the conclusion is that since NPV is less than 0, the project is not supposed to be taken ahead, to be taken up. Okay, I did not plan for this discount of 12%. I just thought we'll just see how the results come up when you use a different discount rates. So that was all, guys, with regard to the net present value, and I hope this was sufficient and clear enough for you guys to interpret and make your own net present value computations. I'll see you in the next session. We're going to start with another method of project evaluation.